let's talk about some of this, I guess. Some of the notes here I gave you, we're going to go through now. Some of the stuff that comes from the book we're using in chapter 3, but predominantly it's out of this financial algebra. FA stands for financial algebra. That's the other book. PFIN is the one we're currently using. So in 6.1 there, we're going to be dealing with a lot of documents, right? Tax tables, worksheets, schedules, that kind of thing. Accountants love these things. But what's the purpose of income taxes, would you guys say? Yeah, go ahead.
Income taxes basically fund the government.
Yeah, it's where the
services like police or
federal and state and local governments get their revenue to do all the wonderful things that they do. We're all quite thankful, I suppose. Government activities, yeah. Tax receipts, in other words, the money they take in, right? And we're going to be mostly talking about the federal government here, right? And a lot of this applies to state and local as well. But the tax receipts, when you pay your taxes and file your tax returns every April, these returns are all administered by the Internal Revenue Service. You've heard of that maybe? Department of the Treasury. And they're pretty tough cookies when it comes to collecting money, right? IRS. And your goal when you pay your taxes is to pay as little as possible, right? That makes sense? Antonio, question?
I have a question. So how do you know? So basically you have to find out how much you can pay, how little you have to pay.
How do you know how much you owe?
Yeah.
Well, we're going to get to that. That's all going to unfold as we go along here, right? That's going to be part of the tax tables and worksheets and whatnot, okay? It has to do with, we talk about tax brackets, I believe, right? Marginal rates, and we'll get into that again. But you definitely want to minimize it, right? You don't want to give up any more of your money than you have to, okay? And so you want to practice what's called tax avoidance, right? And there's absolutely nothing wrong with practicing tax avoidance. Now, there is something wrong with tax evasion. Tax evasion gets you into a lot of trouble. What's the difference between the two, would you say?
It's saving money.
This is kind of the same thing. There's a bit more of a crux to that answer, I think. They're both saving you money, right? Whether you avoid or evade. Antonio?
Avoiding is basically doing the legal minimum, while
Yeah.
evasion is doing the minimum that's paying them.
Yeah, so avoidance is using the tax laws to your favor, right? Taking, and we'll get into deductions and credits and stuff like that. Taking as many deductions and credits as you can, right, legally, as per the tax code, which is stacked up to the ceiling. But tax evasion is really different than that. That's where you illegally minimize or eliminate your taxes, right? Like you omit income on your return, right? Or you lie about having dependents or taking credits and deductions and whatnot. And that can get you into trouble, get you into jail. And there's this concept of enforced compliance. And think about that term for a minute. Does anybody see a contradiction there? The IRS uses this concept. Enforced compliance.
They basically steal your money.
Compliance generally denotes that you're sort of volunteering to do something, right, of your own free will, right? Right? But then that's enforced. And the base word of enforce is what?
Forcing.
Enforce, right? You're compelled, if they have to, by force. I mean, they will bring officers to your, treasury agents to your home or business with firearms, right? If it gets to that point, I mean, not automatic, right? There's a little bit of a process in place first. First, they last get it nicely. Then they get the guns out. Yeah.
So basically, go into your house and steal your money, or what did they do?
Well, if you're evading your taxes, then they're not really stealing, right? They're legally, rendering unto Caesar what is Caesar's, as they say, right? If you've heard that phrase. Yeah. So by law, it's not stealing, right? But anyway, I kind of joke halfway about it. That's not really going to happen to small fish, see if you see that they make a big spectacle about it. I guess the guy ducking them, putting them in the police cars. He's somebody big and rich. And, yeah.
So what if you can't pay your taxes?
Well, there's things you could do. I mean, you can file for what's called extensions and whatnot, but they don't have a whole lot of mercy if you can't pay your taxes, right? You've got to figure out some way to do it. Okay? And they can also garnish your wages if they have to, right? So every one of your paychecks will have a certain amount taken out until your tax liability is satisfied. Then, of course, other than federal taxes, you got all kinds of other taxes, state and local taxes, right? You've been to the store and probably bought something, and, you know, the thing costs $5. But then it costs a little more once you finally ring it out, right? It's sales tax, property tax, which if you're a property owner, you know, here in the village, you got to pay that every year. There's 3 versions of that, by the way, which, by the way, that pays for all this stuff that is provided to you absolutely free charge, right? This wonderful institution here. There's gas tax, everything else, right? So anyway, when you go to file your taxes at the end of a tax year, you have to pick a filing status, right? And here they are, single, you can do married filing jointly, married filing separately, head of household, or qualifying widow or widower, dependent child. The most common ones are going to be single, married, filing jointly, probably head of household. The married filing separately, it's not that common. That's usually like one of the spouses, say, has a business and will be using different methods to file his or her taxes, right? Yeah, but those are the 3 most common ones. Let's see, and everyone has to file a return, right? Whether you even whether you made $1 that year or not. Technically, if you're single and then come over 12,550, you're required to file a return. Or married filing jointly, both your incomes are up to 25,100. You have to file. But I'd recommend filing, like even if you only made $5,000, right? There's a lot of times for the lower incomes, there's enough deductions and credits that you can actually end up getting a refund, right? So you might as well file no matter what you earn. But if you earn, you know, that much single, that much married, you are required to. I think this next section is actually from the Chapter 3, the PFIN book. But anyway, I think we talked about a progressive tax. At least it was in the video. What does that mean? Do you remember?
More you basically more your salary, more you able to on like pay.
The more you earn,
the more you have to pay for. The more you have to own.
It's a little bit more than that, because the way you just described it could be explained with just a flat percentage for everybody, like everyone pays 15%, right? And that mechanic would still take place, wouldn't it?
Yeah.
Right? The more you earn, 15% or more is more, right? But what they mean by progressive is, okay, if you hit a certain amount of income, then you pay a higher percentage, right? We have these different tax brackets, which are here. And I can't remember. When I started it from Chapter 3. I think this is, I don't remember if these are from 2018 or 2021. So I put 2021 here, so I'm going to guess it. Yeah, I guess those are. These are the updated. There's a 10% bracket. If you earn up to 99.50, 12% between these two taxable incomes, right, up to 37% if you're over $523,600. Okay. Regressive tax is a little different, isn't it?
Yeah.
We did talk about that. We want to describe a regressive tax. Or should be the opposite of progressive. So what would regressive mean? The higher the tax, so not necessarily the percentage, right? Like gas tax. Let's say there's 10 cents a gallon charged for every gallon of gas, right? I don't remember what it is in New York State. But let's say you are one of these people earning $10,000. And another guy comes up to the gas pump next to you who makes $500,000 a year. Who's got the greater burden of that? Like
yeah.
That 10 cents per gallon tax is a greater burden on which one of you, even though it's the same percentage per gallon. Like as a percentage of your income.
The guy.
Is a greater burden on him? as a percentage of his income, that 10 cents per gallon is a greater burden on him than it is for you at 10,000?
Yeah, it's for you because less, so that means more.
It's a higher percentage of your income, right? So like sales tax, when you go to buy clothing and whatnot, right? If you're a lower income, that's a greater burden on you, and that's what a regressive tax system is, right? The income tax is progressive, sales tax and things like that are regressive, and these are called margins, right? These are marginal rates, okay? So, and again, so like if you get to the 12% bracket, right, that doesn't mean all your income is taxed at 12%. Just on the next dollar above 99.50. So you make 99.51, right? It's 10% of all of these dollars, and then 12% of that $1 above it. Does that make sense? Until you get to the right. Okay. So, and then when you get done, right, you can very easily figure out what's called your effective tax rate. The book called it the average, but generally it's referred to as your effective tax rate. You just take the result of doing all this to your taxable income, right? That number that comes up at the end, take that final number, divide it by your actual income, and that will be what's called your effective rate, right? Somewhere in between those percentages. Does that make sense? All right. I think some of you are familiar with take-home pay versus gross. You look at your pay stub, right? Every paycheck, you get the full amount of every paycheck. Oh, right. We have withholding tax, right? Your employer is required to pay some of your taxes as you go, right? And we're talking Mrs. Macklin's favorite subject. She loves taxes. She loves to tax people, tax the rich, tax the poor. If it moves, tax it. If it keeps moving, regulate it. If it stops moving, subsidize it.
Antonio, congratulations. That's for your National Honor Society.
You're not going to let me bust your chops. You're just going to ignore me, aren't you?
I know.
Okay. All right. Okay. That's fine. Where was I? Huh? Anyway. So yeah, a lot of money is withheld through the year, right? And the tax year goes from January 1st to December 31st. And sometime in January or February, have any of you got your W? Who works in here again? You do? Who else has a job here? You do. Have you gotten your W-2 yet from your employer? Where'd you say you work? Huh? Harvard. You didn't get a W-2 in the mail, or you know what a W-2 is? That's the document that says how much you earned for the year and how much withholding was taken out for the whole year. Right, all together, it's like they add up what they take out of each paycheck, right? And so, as you do that, the withholding comes out through the year. You've either paid enough of that withholding to satisfy what was supposed to be your tax liability, or you didn't quite pay enough throughout the year, right? And you owe a little bit more. So a lot of people, their withholding throughout the year overpays what they will actually owe. And when you file these returns, the 1040 and all the schedules and worksheets and whatnot, you'll find out what your actual liability is. And if your withholding is greater than that, what you actually owe, then you get a refund check, right, from the IRS. But if you did not pay enough throughout the year, then you have to send in a check with your return. Yes.
Why can't they simply send it like a normal pay? Why can't they send like a single letter?
So what?
To explain how much you owe, but they just like pay it.
Who would send that? Like when?
IRS.
Oh, you mean instead of withholding?
Yeah, so
Oh, right. Well, okay. Well, they decided when they implemented the income tax to have this withholding because, well, what do you think would happen then at the end of the year? You know, and you find out that you file your taxes, there was no withholding, and suddenly you owe $10,000 right now.
Okay.
Without any questions or debate.
Okay.
Or you're less likely, that government's less likely to get that money. So they take it from you through the year, they sit on it, interest free, and they give it back to you. You don't get any interest on it, right? So you're giving them an interest free loan. I'm sorry. Okay. So, but in addition to the federal and state taxes that are taken out of your paycheck, there's also what's called the FICA taxes. You remember what FICA stands for?
Social Security and Medicare.
Yeah, that is that, but what the FICA actually stands for, the Federal Insurance Contribution Act. So Medicare and Social Security is what they call an insurance, which is not really insurance, but they call it that because I guess it makes people feel secure. That's your Social Security. So Social Security is money, you know, that you can have when you retire, so you're not destitute. Medicare is money for medical expenses when you become elderly. And this is withheld from your paychecks, okay? And 6.2% of your income is withheld for Social Security, but not all of your income. Like if, right now in 2021, that they stopped taking that out at $142,800. Right after that, they don't take any Social Security percentage out for it. But Medicare withholding, that's 1.045% with no limit, right? There's no max taxable income. So if you make you earn $1 million a year, 1.045% of that you pay. Okay. So now, Antonio, how do we figure out how much we owe? At some point, we're going to fill out a Form 1040, and one of the lines is going to have your taxable income, and you take that taxable income, and you can go to a tax table or use a tax schedule. Okay. Now the tax table is used to calculate tax owed for people with taxable incomes less than 100,000. Let me give you one of those. Show you what it looks like. These are 2021 tax tables. Okay. So I think I have that here. I thought I had that pulled up. Did I not? Well, maybe I didn't. No, I forgot to print it out. So there's the tax tables for 2021, which is like you guys, if you get your W-2, that's the tax year you'll be fine. Even though it's 2022, right? You'll be paying on last year's taxes. So this goes on for a few pages, right?
What do we do to next year's tax table?
Next year's?
Yeah.
Next year.
What do we do to, I mean, like 2022?
Because you'll be filing for the tax year 2020. The money you made last year.
Oh,
Up to December 31st, right?
oh, okay.
And you have till April 15th, right, to do that. Yeah. All right. So if you see this table here, right? Just go to another page. So take a look at these first two columns, right? If line 15, and we'll get to that line on the Form 1040, right? That's your taxable income. That's what your tax liability is based on. And notice it says at least, but less than, right? And there's an at least amount and a less than amount. So taxable incomes between there and there, you go over here and find your tax liability. Now, how are you going to determine which one of these numbers here that you pick?
It's because it's based on if you're single, married, jointly.
Right. Remember we talked about your filing status? Okay. You just kind of, it's just a row column intersection thing. It's as simple as that. You know, the mistake you come in, right? There's a lot of stuff here, right? And your eyes will dance around. You've got to, if you want to take like a ruler and just lay it across, make sure you're not skipping rows or columns, right? So let me ask you, right? Let's talk about this at least, but less than. This interval here, would you say that if your taxable income was 3,000, we'd use this line? Right? What if your taxable income was 3,050? Would you use this line?
No.
Careful.
I guess.
But less than 3,050. So that's up to, right? And notice the next where you go if you actually earn 3,050. You see what I mean? So this is the less than but not equal to, right? And this is the greater than and equal to. All right? That makes sense. You got to be careful there too if you have to get right on the margin at the edge of the interval. Okay? And then, so this is, and you'll notice that this goes quite a ways, and I said this is for incomes up to, but not including $100,000 of taxable income. Oh, maybe there's another page. Nope, wait. Oh, no, yeah, it goes up here, right? So see, it stops at 100,000, but remember, this is the not up to, but less than 100. So this will go up to $9,999 of taxable income. So then you say, well, what do you do after that? Then you go to something like this, right? Where it just helps you actually, you put the amounts in there and do some calculating. We'll do that, right? And again, there's one for single filers, another one for married filing jointly, etc., right? Whatever. Okay, but we'll get more into that a little bit later as we go through some examples. All right, so keep that handy. We'll get to that soon enough. Okay, let's go to the next page of this. So in the book version I just handed you, there's some examples. 6.1 example 1. Let's take a look at that and read that over. It is right here on page 333. So there's an example. See this? This looks like the table. It's like a portion of that table we were just looking at, right? Okay. So we got this guy Ron, single, right? So we know what his filing status is. Okay. We got that. He's single, and he completes his IRS tax forms 1040, right? And he gets to where his taxable income, which is not necessarily his total income, right? Because there's other things that we can do. His actual taxable income is 51,482. Says use the tax table to determine his taxes. Okay. Well, and they did it with an inequality, right? So look at the tax table, and we're going to be under single, right? So it's going to be some number in that column will be his tax liability, right? So notice how I have the inequality set up here, 51,540, less than or equal to, T is his taxable income, 51,500, less than, right? Not equal to, okay?
So he would have to pay 7,000.
Right. So he just goes over, make sure you're under the single because he's filing single, and his tax liability is $7,183 that he owes. Now, maybe most of that or more than that was taken care of through withholding through the year, right? So maybe in his withholding, you know, he paid over $10,000 in withholding taxes. So he'd get a refund, right?
Yeah.
Well, let's say he only paid $5,000 in withholding, but he owes 71, right? He'd owe a couple grand, wouldn't he?
Yeah.
Right? Yeah. That makes sense? Right. So you guys kind of understand how to take your taxable income and go look in the tax table.
Yeah.
Fine. You just got to be careful. There's a lot of, it's a dizzying array of numbers. It's a giant matrix, right? All right, let's go to example 2, where we're going to use this schedule here. So in example 2, oops, there we go. We're on the next page. All right. We got Maria and Don. They're married, right? Filing a joint return. So we know they're going to file married filing jointly, right? So that helps us out there. They're combined, right? So when you're doing married filing jointly, you add up the two incomes and then go through the 1040 and work through, and they end up with a taxable income of $153,900. So that's over 100,000. We can't use a tax table, right? So we could use something like this. Okay. Now notice how this thing works. Okay. Take a look at this. If your taxable income is over, but not over. So does it include these?
No.
It doesn't, right? Because it says over. But then over here it says, but not over. So are these actual numbers included?
Yes.
They are. Okay.
So basically, if you have $0, you're not going to pay a 10% tax.
Well, to us, 10% is 0. 0, right? Okay. So they are going to end up paying 12% on income above. Well, no, wait a minute. I'm sorry. We're way down here. my mistake. They're 153.9. So they're found right in between here, yeah? Everybody agree? Okay. 153.9 is in between there. So their tax liability is $9,086 plus 22% of any amount that's over what? Let's first talk about where that $9,086 comes from. Where do you think this comes from?
It comes from minusing
Minus is not a verb.
oh, sorry, subtracting. 153, so $153,900 minus subtracting 78,950.
Yeah, well, let's say we work through this bracket, right? He's definitely earned at least this amount, 19,400, right? And what's his percentage of up to 19,400? In other words, what's that number I just underlined?
10%.
Okay. What's 10% of 19,400? Yeah, I was gonna say, just, bring the decimal, right? Or just one. So here, he's gonna owe $1,940. Do you see that number somewhere else? So when he gets to the next bracket, that's what he's liable for, plus 12% of any income over that. That makes sense? Right? So he's definitely from above 78,950, right? Let's do our cut. What's the difference between 78,950 and 19,400? 78,950 minus 9. Well, I didn't do that right. $78,950 minus 19,400. All right, everybody agree it's that much? And what's his tax liability on this amount? 12%, right? That's the amount above that, right? So let's do times 0.12.
And that's how it's filled.
7146 plus that, so plus 1940. Okay, do you see this number somewhere?
Yes.
That's right here, right? So does that make sense now why they just throw those numbers? Those are just random, right? So they, like these numbers here are the numbers that came from calculating your tax liability bracket on the way and adding them up. All right, is anybody confused about that? You guys are mathers, right? Anyway, it's like you almost don't even need to know that. You just trust it, right? Whoever made this up did this correctly, okay? You just follow it blindly, right? Don't ask questions.
Okay.
All right? Good for you, man. So he's in between, right? So their income combined, taxable income, we're going to be careful how we say that, not just their total income. All right, is found between here and here, right? Married filing jointly, so we have to use the one that says married filing jointly, right? You'll notice on that back page of the result, there's a single married filing jointly, had a household, all that, right? So pick the married filing jointly schedule and just do that stuff. Take the 9086, plus, look how I did this. Plus 22% of income above 7850. You see how I find that? I just subtract it. And that's how you get that they actually owe $25,575 taxes. And hopefully they're withholding for care of that in the year, right? And maybe they get a refund, maybe they hold a little bit, okay? All right, does anybody have any questions on like using this thing here? We can use that. But there's another version of this thing, right? That's actually a worksheet that will do the same thing. And notice I have this red arrow, right? So let's take a look at example 3 in the book. There. All right, so the IRS includes a tax schedule, information purpose only, that's what it says, right? taxable income's 100,000 and over, this is actually a worksheet, a form that you fill out, right? Okay? Figure out your tax liability over 100,000. So what are they going to do here? Do you see the intervals here? Taxable income. And this 11B, that's from like 2018. I think it's like 15 now in 2021. They changed the form. So we're going to be using the updated stuff, by the way. So where's their income going to fall? How much was it they made? 153.9?
159.
So which line is that going in here?
That's going into the fourth one.
Everybody agree it's the first line there? Okay, it's in between here.
So
Okay.
and then we time to find-
So, and this would be, I think this is line 15, it'll be right. So let me go back here. Right? So there's all you do, right? So you take that taxable income, 153,900, put it in there. And then what do you do to it?
You will be-
Thank you, Jasper. We times it.
Yep.
We multiply, right? And when you multiply this by 22%, you get 33,858. But that's not the end of the story.
That's the exact amount.
Okay? Then from that, we subtract $8,283. Okay? And then your tax liability is 20. Notice it's the same, right? That's why I drew this arrow down. Notice we got the same amount using this thing or this thing. But this is the thing that's probably a little more directly useful, I would say. All right? Anybody have any questions on how this tax schedule works? We got to pick the right one, right? Don't fill out the one that says single, right? If you notice on the back page of that, oh, here, I already have it, okay. Right? You have one for single, married filing jointly, like, so don't fill this one out for those two, right? You got to go to married filing jointly for those guys, okay? It'll be incorrect figures if you do it that way. All right? So far, so good. You guys stop me if you have anything. All right? Stuff we've talked about already that, yeah, go ahead.
So basically, each section has basically each one has different numbers. And then also, I checked this. So basically, marriage filing jointly is basically similar to qualifying widow.
Does it? I haven't looked at the comparison between the two, really. Could be.
Well, because it says or.
Oh, yeah. It's kind of lumped in with that. You're right. But I think you'll actually, they change it on the forms. I think, and actually in the form, it's like a separate checkbox for the two. They separate it, but it's probably in the same column or whatever it is.
Oh, okay.
Right. So we know what gross pay is, right? That's your earnings before any withholding is taken out. We covered that. And I think you know now what your net pay is, right? What's your net pay? That's the amount they allow you to enjoy. Okay? After you render unto Caesar, yes. Then you have the Form W-2. That's the wage and tax statement. And if you have a job, you either received one of those already or you're about to. Okay? Maybe your parents have it somewhere if you haven't seen it. Okay? That's the wage and tax statement. That's a record of all your earnings for the year and withholdings, right? It totals it all up as a bunch of different boxes. Okay? There's the 1099, right? So this is for income other than wages, right? So like if you get your money's in the bank earning interest in a savings account, the bank has to provide you with what's called a 1099 INT, interest income, right? And it shows, so it's looks a little different than a W-2, but it shows the interest income, right, which you have to technically put on your return as part of your income, right? And there's a 1099 div for dividends, right? Whoever you have your stock purchased through has to send you a 1099 div, it's called. And then royalties is another one, right? There's 1099 miscellaneous, I think, royalties. If you have natural gas royalties that you get paid, you'll get a 1099. I think it's miscellaneous, MIS, right? But when it's a 1099, they're not doing any withholding tax from that, right? Okay, so it could hurt you a little bit if you got. Usually, you guys won't have giant interest amounts that you're in your savings, Doesn't make a whole lot of difference, right? But they don't take any withholdings out of these. All right, so these are some of the income statements, right, that you'll see. That's an income statement, that's an income statement, personal. Oh, we're in 6.3 now. Is that where we are?
Yeah, plus 6.3.
6.3, yeah. Okay, so let's go to we're going to skip to example for this. By the way, this is kind of what a W-2 looks like, right? When you get it in January or February of every year, right? Let's take a look at it real quick. Notice the boxes are all numbered. Recording? Yeah. The boxes are all numbered, right? Wages, tips, and other comp, right? That's what you earn throughout the year. And over here would be the withholding, federal withholding tax in that box too, okay? So that's what you've already paid in towards your, whatever your tax liability is. Then they have the separate Social Security wages box. Why would that be different? Why could that be different? You remember?
For your Social Security account.
Well, remember, your Social Security tax is only taken out of a certain max taxable income, right? What they say it was, 40 something, 140,000. Right. So let's say that what you earned was actually like $200,000 for that year. Then that box would be different, right? It'd be like 140 something, whatever the max is, right? So that's what they calculate the Social Security at. Okay. And this is the Social Security tax that was withheld, the 6.2%, right? This box here, number 5, that's your Medicare wages, right? And right now, that's always going to be the same as your total wages because there is no maximum income for Medicare tax, right? And that's the Medicare that you pay. And then down, there's some other stuff in here where, like, if you have certain retirement plans for your employer or cafe, flex benefit plans that your employer kicks in for you, those will be down there, that kind of thing. And then down here, at the bottom is going to be your state and local taxes that you pay. Okay, same wages, right? Because you also have to file a state return with your federal return, right? So there's what was withheld for state taxes, and we don't have local income tax here in this area. We have property tax, right? But some cities, municipalities that do have a local income tax, where they tax your income. We don't have that here. Property tax, school tax, we have, but not income for waiver, right? So that's a rough look at the W-2, and yours will look a lot like that, right? You'll have your employer's name and address, employer's EIN. That's their employee identification number, right? That's what's registered with the IRS, right?
Oh, okay.
Okay. And it's the same number of digits as the Social Security number. So if it's like a sole proprietor, it'll be his Social Security number. Yeah.
What if you're self-employed?
Oh, we get, so if you're self-employed, that's a different thing, right? So then you have to, what you should be doing throughout the year is using what are called tax vouchers, where every quarter you pay, because no one's withholding it for you, right? But you're going to want to pay a certain amount of money in every quarter to the IRS. They'll satisfy your tax burden. Okay? Similarly, if you're a sole proprietor, right? You make profits, you get to pay throughout the year. So that's different than withholding if you're an employee. Okay? So let's look at example 3 then in the book. 6.3, example 3. 1. There we go. January 30th. Joanne Toscano. This W-2 from her employer. How much does she pay in federal, state, and local taxes? So this is just an exercise in looking over and getting familiar with it, which we just did. All right, so let's just go back here. Okay. Federal withholding, that's your box 2. Okay. How much did the employer withhold in federal taxes? Look at box 2.
It withholds $15,851.
Okay. And how much did her employer withhold in state taxes? That's box 17. Look at the W-2. You want to look at the W-2. Make sure you can see. Box 17. Brady, in the notes thing I gave you, Brady, where was that? That's the book part. That has the table there too, with the W-2. So 5,300, 44.50 cents. And then they box 19, if there is any, be the local withholding at WH I got for withholding, right? So the total of all the taxes she paid, federal, state, and local, if you add them all up, it's pretty right. $22,287.50. Now that's not necessarily what she owes, right? That's what was withheld. And then when you file your return, right? If this is more than what you're actually liable for, you get a refund.
Well, if it's less than
If it's less, right? Then you owe. Exactly. Okay. Well, let's see. Tax deferred retirement plans, right? And that'll be something that's on the W-2 as well. So for your employer, a lot of times they'll have like a 401k or a pension. The teachers here have a pension, or a 403b, which is the same as a 401k, but for state employees, but whatever. So a tax deferred retirement plan. What does that mean? You can also think of it as pre-tax. So through your lifetime, as you know, before you retire, while you're working, you can contribute to a retirement plan. Certain money out of your paycheck.
So basically it's like a tax.
One way to do it is with pre-tax money. So like before your withholding comes out of your paycheck, you can take that money that you earned before it gets taxed and put a certain amount into it, right? Into a retirement plan. Okay? What's nice about that is it's money that you haven't paid taxes on, right? And so whatever you put into a retirement plan like this throughout the year, right, you don't have to pay taxes on that money.
That's good.
So let's say you earned $50,000, right, through the year. And 10,000 of that you used before taxes were owed on it to put into your retirement plan. You with me?
Yeah.
Okay? So when you go to file your tax and find out your tax liability is not based on $50,000 of income, right? It's only based on the $40,000 after you put the stuff in. So what will that do to your tax liability if you use these pre-tax retirement plans throughout the year? What will that do to the money you actually owe for taxes? Come on. It's a simple question, so either you're not listening or you're not listening. Reduce it, right? With like a percentage of 50 is higher than a percentage of 40, isn't it? So you reduce your tax liability. There's participation, Brady. Was that you? All right then. There we go. Brady's off to the races. Okay? So it reduces your actual tax liability at the end of the year. Right? So that money you put in to your retirement fund goes in basically tax-free. Okay? But then when you retire, then you end up paying taxes on that money you put in. Okay? And the types of plans that work like this, the tax deferred, will be what's called a traditional IRA, individual retirement account, right? A 401k or 401(b). And of course, because it reduces your tax liability, there's yearly contribution. What is it? I think it might be like $10,000 a year or something like that. I don't remember it now. But obviously, you're not going to be able to take your entire income and put it into a retirement account. Yeah, right. Okay. So what it means is, we just discussed, you pay less income tax today, right? But then you pay those taxes at retirement when you start withdrawing the money, right? But what's the advantage? When you retire, you generally earning more or less income.
Oh, well,
So you'll likely be in a lower tax bracket when you retire, right?
that means less.
So that money you would have paid now, right, in a higher bracket is now being paid at retirement in a lower bracket, so a lower percentage. So can you kind of see the advantage there? Okay. All right. Wow. Okay, so that's tax deferred. And then there's tax exempt or after tax retirement plans that you contribute to. It would be, maybe you've heard of a Roth IRA or a Roth 401k. So this is after tax money, right? This would be your net take home pay that would go into this through the year, right? So your contributions are made with after-tax income. So you've already paid tax on this money, right? Now that you pay tax on it, you're taking what's left and putting some amount of it into this retirement account. Or that amount you put in has already had taxes paid on it, right? So when you retire, since you've already paid taxes on that money, what happens at retirement?
You get no income tax.
You don't have to pay taxes on it again because you already did throughout your life, right? That was after-tax money. It's already been taxed. They're not going to tax you again on it. Yeah.
What do you think is better?
It depends on your, most people prefer the Roth, right? We get that, but it depends on your situation. It's individuals. Everyone's got a slightly different situation, right?
Okay.
And also you think, okay, you've made, it goes into an account that earns, right? It gains interest, capital gains and that kind of thing. So it grows, right? Compound interest. There's no capital gains tax on that retirement earnings. So you've already paid tax on the money you put in. So you don't have to get it taxed again. And the earnings that it makes by the time you retire don't get taxed.
That's good.
Right. So a lot of people like this. But anyway, get into which one's better will be on the scope of this class. So,
Okay.
so just want to give you an idea. Flexible savings accounts. That is when, so you know how your mom and dad take you to the doctor and it's a copay or something like that, right? Or prescription copays or things that your insurance doesn't cover. Okay. A lot of employers will offer what's called a flex plan. FSA are called a cafeteria plan. We have a certain amount of money that you can use to cover for certain medical health expenses like copays and whatnot, or even child care, right? They're real picky about what you use it for, okay? You're not allowed to go out and buy a flat screen TV with it, okay? Because it's, you know, by law, pre-tax money available for these certain particular items, okay? So again, this is money that'll reduce your tax bill for that year, and it sits there waiting for you to need it for, yeah, well, not even emergency, right? Like for example, we have a really good health plan here, but we don't have dental, right? But they offer us this. We have this cafeteria plan. We have an account all set up here, where if I need to go to the dentist, I have it's got a balance. I think mine is sitting with a balance of maybe like $10,000 in it. I can't just go use it at Walmart, right? But if I go to the dentist, right, and I got to get some work done, $2,000-3,000 worth of work. Oh no, my insurance doesn't cover that. I just hand them my Flex Plan debit card and swipe it, and it's paid for out of that account. Okay? Yeah, it's pre-tax money, all right, and it's untaxed. And of course, as usual, yearly contribution limits. Okay, you don't want anybody hiding all their income in something like this, so they put caps on. Okay, all right. Well, that's what I marked for day one, I guess. And we'll start the day two tomorrow. We'll get a little bit more into the documents and schedules and whatnot. Does anybody have any questions? I know we covered a lot. Some of this is new to you guys. Maybe a little confusing. So I want to ask any questions. Antonio, figure you have one.
So, I'm confused. So, the cafeteria plan is basically made for specific circumstance. So,
Yeah,
is
like
there like a cafeteria plan for different situations, or is there like a broad sense?
it's broad in this. It's broad end. It's the way you ask it. It's broad and narrow, right? It's broad in the sense that there's only one cafeteria plan.
Okay.
And its allowable uses are certain healthcare costs, right, that aren't covered by insurance or like dental, right, or vision or something like that. If, you know, I have to come to work and pay for a babysitter or daycare, right, I can use that, take care of that, right? I think they also allow you to use some of it for like gym memberships, you know, something like that, right? That's, you know, part of healthcare, preventative health and all that stuff. But sometimes what happens is like I'll use it and then the plan administrator will send me a notice that, okay, we need itemized receipt for this. We need the whole bill of sale, exactly what you got done, right? Because if I use it for something that's not allowed under the tax code, right, then I'm liable for it out of my pocket, right? So, okay, we're not going to cover that. We can't legally do it, right? Tax law doesn't allow us. So if you do that, then you owe the money to, so like, I owe Best Buy $5,000, okay, for that TV I bought. because that's not coming, right? Any other questions?